Hello everyone! In the last lesson, we left off talking about option pricing. Today, I want to talk about the elements that influence option pricing. There are 6 factors that can change the price of an option, some certainly more important and more powerful influencers than others. Many new option traders may not consider some of the minor influencers, or perhaps they don't even know about them. That's okay, but there will be times when they leave money on the table. So I want to make sure I cover all 6 factors so there's no question on why an option price might have changed. Once we understand how these pricing elements affect an option, we'll be able to execute trades that allow us to profit by taking advantage of the expected option price movements. These are factors that every option trader should know. In fact, when I got my first job in the options exchange, my boss would quiz me on these option pricing elements every few days. So I highly recommend you take notes, especially on this section. Once we cover the basics, we'll then be able to implement powerful strategies that capitalize on what we have learned. These 6 factors are the price of the stock, the selected strike price, the amount of time to expiration, the volatility of the option, interest rates, and if that stock offers dividends. Some of these things might look familiar, and they should, because we have discussed several of these factors already. Let's first talk about the price of a stock and how this affects option pricing. When we talk about a call, we know this gives us the right to buy stock at a certain price in the future. So it should be no surprise that the higher the stock goes, the more that option will be worth. Let's look at 2 scenarios. First, we own a call option with a strike price of $100, where the stock is currently trading at $90. Second, we own a call option with a strike price of $100, but the stock this time is currently trading at $120. Which would we rather own? Clearly, option 1 has less value. No one is going to exercise a call and buy stock for $100 when they can just go into the open market and buy it for $90. Option 2 is far more appealing. Being able to buy stock for $100 when it's currently trading $120 has far more value. There would be $20 worth of intrinsic value in this option, plus the remaining time value. Puts work the same way, but in reverse. Would we rather own a $100 strike price put, which means we can sell the stock at $100, when the stock is trading $110 or trading $80? Obviously, owning a put contract that allows you to sell stock at $100 when the stock is currently trading $80 is going to have more value. Because stock prices are always changing, if you own a call and the stock goes up in value, then your call will also go up in value. However, this has an inverse effect on puts. Stock price increase means put price decrease. Furthermore, if you own a put option and the stock price decreases, then that will cause your puts value to increase. Just like with the other scenario, when puts increase, calls decrease. So a stock going down in value will cause the call options to also go down in value. This brings us to the strike price, which is our second pricing factor. In the previous example, we owned a 100 strike price option, and we evaluated what happened when the stock moved. But now let's take a look at our option chain and see how our strike price values based on which strike we consider. Here I have pulled up Disney stock on our favorite platform, Thinkorswim, which is currently trading about $107. Thinkorswim does a great job of separating the in-the-money options from the out-of-the-money options. In-the-money options have a purplish background, while out-of-the-money options have a black background. Remembering from before, when a call is in the money, it means the stock is trading at a price higher than the strike price. When a put is in the money, it means the stock is trading at a price lower than the strike price. In the case of Disney, any call option strike below $107 is going to be in the money. Any put strike above $107 is going to be in the money. Strike prices that are deeper in the money have more value. In the case of Disney, we can see this very clearly. A 105 strike price call is worth about $4.55 less than a 100 strike price call, which is worth about $4.60 less than the 95 strike price call. Having the right to buy stock for a lesser price translates into more value for that option. In the case of puts, if we want the right to sell stock for a higher price, that translates into paying more for that put. We could buy the right to sell Disney stock at $140 per share within the next 28 days, but that's going to cost us a hefty $34.80, or $3,480 per contract. Remember, option contracts control 100 shares. If we decided to buy the 120 put instead, that would cost us a lot less money. Being able to sell Disney stock at $120 a share has a lot of value when the stock's trading at $107, but that certainly has less value than being able to sell the stock at $140. This makes sense, as we can tell from our option chain. The deeper the option is in the money, the more expensive that option is. This is because the better strike price execution we get on that option, the more value that option has. When it comes to an option's value on expiration, there's no time value left, as the option is expiring and its life is ending. If that option is out of the money, it won't have any value at all, and that option will expire worthless. If that option is in the money, the option's value will be made up of 100% intrinsic value, the difference between the strike price and the stock price. Basically, if we have a 100 strike price call and that stock is trading 107, then that option will be worth $7. If we have a 100 strike price put and that stock is trading 89, then that option will be worth $11. Let's head back to Disney and take a look at the May options that expired today. Disney closed at 107.52. Now, these marks might be off by a couple of cents because the mark figures are the average of the bid and the ask, and people are going to be bidding a few cents less than what the option is worth and asking a few cents more. This is because traders are not willing to do a trade unless they have something to show for it. They're going to want to earn a few cents for their troubles, or there is no point in making the trade. As you can see, no one is bidding for these worthless, out-of-the-money options shown in the black area. But there are certainly people willing to sell them as they have zero value. And selling something with zero value, even for a few cents, is better than nothing. These out-of-the-money strikes would rarely ever trade, but there's a market there, just in case. Looking through the option chain, we see the 107 call should be worth about 52 cents, and it is. The 104 strike price call has $3.52 of intrinsic value, and that is right in the range of where it finished trading. For every dollar we go deeper into the money, the option will also increase by $1. Looking at the puts, the 110 put should have a value of about $2.48, and we can see that's also right where it ended up. Remember this, because owners of these puts will be allowed to sell stock at a price of $110, with the stock's real value at $107.52. This means there is $2.48 of intrinsic value, and that is the only value these puts have, as they have just expired. So, just to review, out-of-the-money options, once they expire, have a value of zero. In-the-money options have a value of only their intrinsic value, which is calculated by taking the difference between the stock price and the strike price. Looking back at our June expiration, which is next month, we see out-of-the-money options have some value, and if we look even further out in time to September, which is 4 months away, we see those same strike prices have even more value. So what's happening here, and why do these out-of-the-money options have value? These options have value because they have our third point in option pricing, more time to expiration, what we commonly refer to as time value. Options have a limited lifespan, thus their value is affected by the passage of time. The more time an option has, the more value that option has. If we have a car that is worth $30,000 and we go to buy insurance, we will have to pay a premium of $100 every month. That insurance contract is good for 1 month, and every month we must buy a new one for $100. We also have an option to buy the exact same insurance, but to pay every 6 months, and that will cost us $600. Options work the same. We can buy 1-month coverage, or we can buy 6-month coverage. We just have to be certain about the length of coverage we want. In our car insurance example, if we only buy 1 month of car insurance, forget to pay our bill, and then have an accident the day after our insurance lapses, it's too bad, so sad. Our insurance company will not cover our car, and we will have to eat the full cost of the damages. Well, guess what? Options work the same way. If we own a 1-month put option, and the day after our put expires, the CEO of the company dies and the stock gets crushed, we're not covered, and we get no benefit. So, the more time we want, the more it will cost us. Going back to Disney, we see our September 100 puts are, in fact, out of the money, but they still have $1.64 of value because stock prices move, and they give us a protection against downward stock movement over the next 4 months. Disney could very easily take a turn for the worse, and that 100 put that's currently out of the money now could finish in the money by September. Until that option expires worthless, there's always a chance it could finish in the money, and that's why it still has value. Looking at our Disney option chain, we can see that the further out of the money the option is, the smaller the contract price. That's due to the fact that the further out of the money we go, the lower the probability of that option finishing in the money. And if it does finish in the money, the exercise price will be at a lesser value. As we just discussed, the more time the option has to expiration, the more that option is worth. However, as that time to expiration gets closer, the value of that option begins to decrease. With every passing day, there's a little less time to expiration, and that less time is reflected in the option price. For these reasons, options are considered to be decaying assets. For example, if we purchased one Disney September 100 put for $168, and the stock just stayed right where it was, trading sideways over the next 4 months, that put would start to decay away. With 4 months to expiration and the stock trading at 107, that put is worth 168. However, next month, with the stock in the same place, that put is only going to be worth 121. In July, with the stock still trading 107, the value will fall to only $64. In August, only $20, and in September it will be worth nothing. Where would the stock have to go for us to break even? Remember, with puts, we calculate our break-even by subtracting our option premium per share of 168 from our strike price of 100. So our break-even would be 98.32. We start cutting into our losses once the stock goes under 100, but we do not start to turn a profit on this trade until the stock goes under 98.32. As you can see, time would be our biggest enemy, decaying our option away, reducing its value so that it expires before we could reach a point of profitability. This is why successful option traders don't go nuts buying out-of-the-money options. Not only will the stock have to move in our favor, but it will have to move enough to account for all that time decay. We can measure this time decay in something called theta, which represents the amount the option decreases in value daily due to time decay. This is why at OptionsStrategiesInsider.com, we choose a strategy that takes advantage of time decay. And instead of having time be our enemy, time becomes our ally. Now, don't worry, we're going to talk more about this later. For right now, I just want to make sure you understand why going out and buying a bunch of options is not a good strategy for success. So far, we have covered the first 3 factors of option pricing. These include the stock pricing and how the fluctuation of a stock's price affects the option's value, how the strike price chosen will affect the value of that option, and the likelihood of it finishing in the money at expiration. Finally, how options are decaying assets that have limited lifespans, thus losing their value little by little with each passing day. Later on in this course, we're going to talk a lot more about time decay and how successful option traders use it to their advantage. So I urge you to make sure you finish this course. All right, I know this was a lot to take in, so let's stop right here. And in our next lesson, we'll start fresh with our 4th option pricing factor, and my personal favorite, volatility. See you soon.